Welcome back to the deep dive. Today, we're digging into something kind of huge that's quietly brewing in your retirement savings, a real potential game changer. Happened just a few weeks back, actually, August 7th. President Trump signed this executive order, and it basically rewrites the rulebook for investing. We're talking crypto, private equity, even real estate potentially coming to your 401k. Now, if it sounds like a big reversal, you're right. It is, because just 2 years ago, 2022, the Department of Labor was pretty much warning everyone against crypto and 401k, called it a regulatory liability. But now, suddenly, it's a permissible component in the massive, like, $12 trillion U.S. retirement system. Big shift.
It really is. For years, crypto felt like this sort of digital frontier town, right? Just traders, speculators. But one order might have just plugged it into the core of American savings. So yeah, that's what we're unpacking today. What exactly changed? Why should you care about it for your own portfolio? And how this might reshape the whole market. We're thinking savers, not just traders, driving the next chapter.
Right.
Okay, so the nuts and bolts. This executive order basically tells the Department of Labor, hey, you've got 180 days, revisit your guidance for fiduciaries. That's the legal duty employers have to act in your best interest financially, and they need to create new safe harbors.
Right, the legal cover, basically. So employers aren't terrified of getting sued for offering this stuff.
Exactly. So that big regulatory hurdle, gone. Poof. But hold on, don't expect to see Bitcoin next to your mutual funds tomorrow morning. This retirement infrastructure stuff, it moves slowly.
Yeah.
Like deliberately slowly. There are layers here.
Oh.
You've got the record keepers, the custodians, think Fidelity, Schwab holding the assets. Then asset managers need to design the actual funds. Employers, the plan sponsors, they need that fiduciary protection spelled out. Even the target date fund guys have to figure out where or if crypto fits in their mix. It's a lot.
Yeah, totally. Historically, these kinds of changes, even just getting target date funds mainstream, that took, 3-5 years? It's a maze. But here's maybe the interesting part. Crypto's got a bit of a leg up, doesn't it? We already have ETFs trading. The infrastructure exists in a way it didn't for other alts back then.
Yeah.
So yeah, not overnight, but maybe, just maybe, we see the first products in, 12 to 24 months? Faster than usual anyway. The door's definitely open.
Kicked open, perhaps.
Right. So let's talk scale, because this is where it gets kind of mind-bending. You said $12 trillion in 401ks alone. Just let that sink in. That's like 5 times the entire crypto market cap right now, roughly. And if you add in all U.S. pension funds, you're pushing $27 trillion.
Staggering numbers. And it's not just the size, it's the type of capital. This isn't hedge fund hot money chasing the next pump. This is like the coldest capital on earth. It comes from over 60 million active employee accounts. Little slices, automatically deducted, every paycheck for decades.
Wow.
It's just this indifferent structural force, the American paycheck. It doesn't care about the price today, it just allocates. Week after week, month after month.
So even though, Wall Street's old pipes will probably make this transition messy, lots of lawyers involved, I'm sure.
Oh, for sure.
But the takeaway is the path is clear. And that money, it's going to find its way through eventually.
You will. And that leads to the next big question. What happens when that kind of relentless structural buying meets an asset famous for its, limited supply?
Unstoppable demand, shrinking supply. That's the classic setup.
Pretty much. Think about the potential flows. A tiny allocation, say 0.5%, 0.5%, that could funnel $60 billion into the market. That's like 4 times what the initial ETFs pulled in this year. Bump it to 5%. You're looking at maybe $600 billion. That's half of Bitcoin's entire market cap today from just U.S. retirement funds. And remember, Bitcoin's design, it's programmed scarcity. Supply is limited, predictable. After the halving this year, we're only getting about 160,000 new BTC annually, and that halves again in 2028.
So less new supply.
Meaning potentially way more demand. Every single paycheck cycle adds buying pressure. It turns crypto, especially Bitcoin, into an asset with potentially a permanent bid. Over time, that could seriously soak up the available supply, the free float on exchanges, maybe even dampen the crazy volatility we're used to. It becomes less a trader's game, more an institutional asset.
Oh, okay. So boiling it down, what does this actually mean for, say, your standard 60/40 portfolio, the one financial advisors love? Because the argument has always been, crypto's volatile, but even putting just 1 or 2% Bitcoin in there, historically, it's juiced returns, right? Like 50 to 100 basis points extra per year.
That's what the backtests often show, yeah. With only a small uptick in overall portfolio volatility, it acts like an asymmetric bet, limited downside risk relative to the potential upside.
Which, that does raise a big question. If crypto offers that kind of potential, maybe uncorrelated return, Does it change how we think about diversification itself? Do bonds or gold still play the same role?
That's the million-dollar question, isn't it? Or maybe the trillion-dollar question now. Advisors are definitely going to be wrestling with this.
Yeah.
My guess, initially you'll see these multi-asset alternative funds, crypto blended with private equity, real estate, commodities, stuff like that.
Ah, okay. Package it up to smooth things out.
Exactly. Smooth the ride, look diversified, reduce the legal headaches for the provider. But down the road, as everyone gets more comfortable, as the legal precedent gets clearer, yeah, I think you'll see dedicated crypto options, a specific crypto sleeve you can choose.
Makes sense. So, wrapping this up, the big picture feels like, don't overthink the messy details. A huge wave of retirement money is heading towards crypto. Starts with the big ones, Bitcoin, Ethereum, probably, but likely won't stop there.
Yeah, that's the core of it. This isn't just a fad, it's structural. Every 2 weeks, for potentially the next 30 years, a bit of America's paycheck automatically buys into this asset class. It's a permanent bid being built into the market. Fundamentally changes the supply-demand equation.
So here's a thought to leave you with. How does this shift crypto going from this weird alternative thing on the fringes to potentially a standard piece of retirement planning? How does that reshape, I don't know, everything? Mainstream finance, how we plan for the long term, maybe even for the next generation.
Something to chew on.
Definitely. We'll leave it there for this deep dive.